Hi there, this is Robin Hart with the Home Loans of Hart team of CMG, where we are here to help you build wealth through the financing of real estate. This is our weekly video where we share with you some insights on where rates are at and what's happening in the mortgage world and some fun stuff at the end. Let's dive on into rates and see where they're at. Rates have kind of been steady. Bumping around at their current levels. They've been previously at a downward trajectory, kind of a kooky, spooky kind of fun way, but at the same time, they're kind of hesitating right now. This is some information provided by Mortgage Nuggets, which is an online mortgage reporting tool. They take in an average of over 200 lenders across the nation and average for the previous 7 days what those rates are. These are not rate quotes, but they do give you a good idea of a general rate department of where average lenders are. The 30-year fixed is coming in at 6.18, where the 30-year VA and FHA are peaking in underneath 6% at about 5.92. Okay. All right. Now, emails were probably flying around if you want a home or have bought in the last several years. Lower rates, the time to refinance, all these questions, and pretty much I'm here to break down the rub, sort of, because I've spent more time telling people right now is probably not your best time to take a mortgage at this point. Okay, so here's the thing. Unless you are trying to receive cash out, which in the case scenario, usually with that cash out, you're looking to do something, whether it's pay off bills or do some renovations or invest in a project, something like that. There's no real hesitation towards why you should execute. However, if you are just doing a pure rate and term refinance, these rules apply to you or should apply to you. There is basically an element of you want to save about 1% off of your mortgage rate. So if you have 5.25 rate, you want to look for a 4.25 or better. Okay. Now keep in mind, there are costs to refinancing. And you may not be paying those costs out of pocket, but it is your equity that can be swallowed up with those costs and those fees. So here's the rub. Again, you typically need to save about 1% or more to make a large enough difference in your payments. Now, you don't want to go off of just payment. And the reason being is because the size of the loan will actually change and impact the amount. And it might sound great as far as saving $200 a month, but if it costs you $14,000, it takes a really long time to break it down and make your money back. So you want to look at overall interest rate and APR. Now, I've spent more time in the last 2 weeks telling people, yeah, you could get that rate, but you're paying so many points to get there, it's not even worth it. So here's the deal. You don't want to go blowing your equity, falling for something that's less than right for you and your family. So if you and your client, if you or your clients need some help with that, we can set up a target rate so that you know when it's beneficial, and then you can kind of watch these videos or call in periodically, trying to check where rates are, and then we can hit that target rate, or when we're right about an 8 to 1/4 above it, we can start the process of applying and prepare your application. It actually only takes about 5-10 minutes to figure out what your target rate is. So give me a call. We can work it out really quickly. All right. Now, last week, we did announce that Russell Vought, he is the White House budget director, he announced on the Charlie Kirk podcast that their intentions are to end the CFPB and pretty much demolish the entity within the next 1 to 3 months. Now, not really a surprise. This administration really likes deregulation, but what will follow from the CFPB being completely disseminated would be that the GSEs are going to be released soon. So here's what was announced this week. FHFA chief says the government could release the GSEs soon. Now, what does that mean? That means FHFA or Fannie Mae, Freddie Mac, they're currently in conservatorship. Now, here's the deal and the breakdown of it. All right. As a lender, I love this because overall, in the initial sector, it will actually lower costs. There's these things that under the conservatorship that the GFCs have to follow, which are loan level pricing adjustments, which are actually add-ons to the cost of a borrower on a mortgage. Basically, depending on how much equity you have or how much your down payment is and where your credit scores are at, it might add a additional cost to the mortgage loan. So ultimately and initially, it will lower costs. But as an American, it will ultimately add to the national debt. So if you have concerns about the national debt, here's the numbers. In 2008, during the financial crisis to save Fannie Mae and Freddie Mac. The U.S. Treasury dipped into its funds and provided an initial $100 billion loan to FHFA, and then added to that to ensure their survival. Now, the total cost came in at about $191.4 billion to FHFA. And specifically, it was broken down. Fannie Mae took $119.8 billion, while Freddie took out $71.6 billion. Okay. Since then, they paid all of that back. They actually paid it back in like the first 4 years, I believe. Now, since then, because of the way the deal was structured, dividends have also been paid out to the tune of about $301 billion. That means federal government has made $301 billion off of loaning the money and made the money back. Okay, so we've made almost triple the amount of money. Okay, and we still have these stock incentives with it. All right, so ongoing, it has been a good investment and a great partnership. FHFA got to survive. U.S. Treasury made billions, excuse me, and meaning the government has made more money than they spent, and that was a clear investment, and it made a great partnership for both entities. However, entities seek out to make money, so they want to be released from the conservatorship. Now, here's the thing. The news pundits are going to tell you U.S. will make about 30 to 300 billion, depending on the IPO. All right. Now, I'm not sure how they can do an IPO of it because it's already an entity. There's a lot of stock owners already, but basically they would release it and back into the stock market to be online traded as a free earning company. Now, here's the thing. If the federal government releasing the GSEs could make up to $300 billion, guess what? We were already going to do that over the next 10 years. As a matter of fact, the trajectory was going to be closer to 500 billion is what the U.S. Treasury would have made off of retaining this GSE, okay, and keeping it under the conservatorship. Weirdly enough, private sector, we're talking hedge funds managers, they're probably going to receive somewhere between $500 billion and $1 trillion in funds just for the release. Why? Because it will go back onto the stock market and they will ultimately gain the initiative of a privatization company, meaning they will seek out profits, meaning higher prices, and ultimately make costs go up for homeowners. So in the end, it will shorten in the short term, lower cost, in the long term, raise cost, and overall, it will also raise the federal debt. So it's kind of a mixed bag of tricks, but at the end, the tricks are all on the side of the hedge fund managers. There you go. All right. Now, government shutdown. Yep, still happening. No difference. Don't see an end in sight. Nobody's moving. Nobody's budging. And there's just lots of talk. It's political drama, if you will. All right, whatever. Anyway, let's make it happen and have some kind of fun. This is super cute. The tiniest little ring bear dozed off in a mini sports car while driving down the aisle during the wedding. Now I watched this video. It's adorable. Apparently it's one of the remote controlled cars and the kid is just completely sacked out and exhausted but they still continued on with the wedding and he still went through. So adorable. If you need a good laugh, check it out. And then here's our meme of the week. Scary costume. It's going as your property tax bill. How about that? Yeah. All right. Now, you might be asking yourself, when is the best time to buy or refinance? Well, depends on you. So let's check it out and do an analysis to see if it's a right time to buy for you. For people who have savings, pay their bills on time, and you've been paying rent for years on end, that rent's never coming back to you. So it might be a good time to buy, especially with all the incentives that are happening right now in the marketplace. If you like this video, please follow us on any of our social media programs. We are on LinkedIn, Facebook, YouTube, and the artist formerly known as Twitter and Blue Sky. I'm Robin Hart with the Home Loans with Hart team, where we're here to help you build wealth every single day through the financing of housing. Have a great week, and we'll get back to you soon.